The clock has been ticking, and now here we are, bumped up against the U.S. government debt ceiling. It's going to be interesting to see where they take this, and equally important for you to understand exactly how U.S. government debt works. And I'll jump into that right now.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Hey, welcome. As we like to say here at the Trending Report, trend lines beat headlines. And I'm going to be talking to you about market data ending as of last Friday. That was May 19th. But equally important, we're going to be taking the complex and making it simple, discussing what's going on with the U.S. debt ceiling and the fact that the government needs to increase that ceiling to continue to operate the government, and exactly kind of the situation that we currently have at hand. With that being said, let's jump right in. So I've got quite a bit going on in this sheet in front of you. But first off, on the far left here, the current government debt level sits at $31.4 trillion. That's the ceiling that we have hit. Now, when you look at U.S. government debt, it accumulates the same way debt would accumulate in your home. If you have income or revenue coming in the front door and you have spending or expenses that are going out, if you have a negative number left over, that is a loss or a deficit, as the government likes to call it. If you would have had a positive number left over, that would be obviously a profit or a surplus in government speak. Now, if you're doing this year after year after year after year, and in the case of the U.S. government, you're continually running a deficit each of those years, well, those numbers tally up to a total, and that overall total is what's called debt. And so that's what you see with this debt ceiling of $31.4 trillion. And then here's a chart to bring it in perspective. This is at the end of last year, 2022. So it's about 6 months out of date, but still gets you very close to what's going on. At that point in time, we were looking at about $31 trillion of debt. So about another $500 billion has been added in the last 6 months. And you can see that this is just a mountain chart of debt as it continues to tally on through time. But you can also interpret quite a bit from this chart if you look at some of the details. So for example, look at this sharp incline right here. Well, that was to fund World War II. And so this was the cost of World War II, so to speak, in terms of running a deficit to combat the war. And then you can see it settled just a little bit. And then we basically flatlined all the way up to 1982. Now, after 1982, things really took off and we see some steep increases. Now, many people, when they see that stretch from the end of the war, World War II, that is, up until the early 80s, and they see that kind of stretch, they're a little bit baffled at how did we end up flatlining? Well, part of the reason is over here in the fact that when you're looking at your debt compared to your gross domestic product, that's the entire output of the country, the GDP was outpacing the debt. So it was each year it was the debt was representing a smaller percentage against the GDP. And so that kind of offset the interest that was being paid on that debt, and it translated over here into basically a flat line. Then you can see in 82, it takes off, which is the same takeoff that we see happening right over here. And then the interest on the debt, it works again, similar to what you would expect in your home. So if you were paying only the interest and not the principal on that debt, our current average is a little over 2% is what we're paying on that total debt at the U.S. So a concern happens to be that as interest rates are now rising, that this is going to rise as well. And that's going to add kind of salt to the wound, so to speak, as we move forward with the U.S. government debt. So keeping debt under control is important. I will tell you that some will argue we should have no debt. Most economists will tell you you do need some debt To run a healthy, viable economy, you just don't want it to get out of control. Many people over the years were very concerned when we broke through right here, this 100% number. And today we are at 124% or 125% roughly. So many would maybe argue that we want to get this back down to about 100%, and we want to try to stay somewhat in that range or even below. But many economists have different thoughts and theories when it relates to that. Now, all of this is obviously going to have an impact on the stock market, especially as we come up against the government having to deal with this June 1 deadline in terms of running the country. So let's take a look at what the markets are doing right now. Here we are looking at capitalization. This is everything from small cap to large cap. Our calculations showing green means we're leaning bullish. Showing red means we're leaning bearish. Here we're looking this in the center section on the chart. We're looking at the overall total stock market. As you can see, the green above, what's lifting the market these days continues to be large cap. The S&P 500, the S&P 100, which are your large caps. Down here in the red, see this red here, we're seeing the mid caps and the small caps are coming in there. Here you can see these high points. These are points of resistance. In other words, it's kind of like bumping up against the ceiling. And the green are points of support. What you can see is, they're kind of coming together here to a certain degree. And right in here is kind of the market kind of growing in that midsection. And that's why we're seeing this macro going from bearish to bullish right about there. So right in this range in here. And we are currently in our most closest nano view. We are seeing the overall market turning a bit positive as of late as well. Now, if we look at this same market, but we're breaking it down by sectors, and in this case, we equal weight the sectors for the charting, you can see what's pulling or lifting these sectors up is information, telecom, consumer staples, as well as consumer discretionary. What's really pulling it down, utilities, real estate, financials, and energy. So again, you're seeing a very similar pattern. We're seeing the support line and the resistance lines kind of coming together, the market kind of funneling its way to growth in that area. We are seeing the green taking off in about the same space on the macros with a little bit of red here and there. But look we're getting a conflicting signal right here. We're actually getting red in the most minuscule viewing that we do, which we call our nano calculations. So a little bit of confliction between the sector analysis of the market and then the capitalization analysis of the market. Internationally, the market's actually looking a little stronger than it is here in the US as of late. You can see there's quite a bit more green up here with the dots. The overall international stock market is definitely got more of an upward incline to it. You can again see the support and the resistance lines driving a higher incline in terms of growth. Right back here, going all the way back to December is when we saw the macro go from bearish to bullish on international. And then finally in the bonds, in the total bond market, we're seeing it pretty much in a ranging market. We've got some resistance here, some support here. I said those in reverse, support on the bottom, resistance on the top. And the market's kind of ranging in the middle. In the nano, we're seeing red. In the macro, we're seeing green. So the bond market is continuing to fluctuate back and forth, not giving us a really good pattern one direction or the other. So what will most likely happen is that once the government settles the debt ceiling situation, you will see the patterns start to kind of break back into more of a norm, I would hope. And we'll see hopefully once the problem is solved successfully, we'll see the market on the rise. If it's not solved successfully, we will definitely see the market on the decline.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.